Welcome back, everyone. So, former US President Donald Trump announced in late October that he would be launching his own media network, which will include a social media platform called Truth Social to stand up to the tyranny of big technology, according to the website. The idea being that it's a censorship-free version of Twitter. Now, the app is supposed to be the first project of the Trump Media and Technology Group, TMTG, which will be listed on Nasdaq through a merger with a SPAC that's called Digital World Acquisition Group, or DWAC. Now, we've covered SPACs and how they work on this channel quite a bit over the last year or so, but to quickly recap, SPACs are an idea that's been around for quite a while, but they suddenly became very popular in 2020, and they faded a little bit since then. A SPAC is a company that goes public raising money through an IPO with the promise that it will, within a certain time period, use the money raised to merge with a private company. They're often referred to as blank check companies for this reason. Through the merger, the private company becomes a publicly traded company without having to do its own IPO and without the same due diligence that would typically be required of a company going public. In theory, this arrangement gives regular people the ability to invest in private companies before they go public, and it also offers private companies a way of raising money and becoming publicly traded. Now, usually in these SPAC deals, the SPAC is paired with what's known as a PIPE, which stands for Private Investment in Public Equity. Usually, big institutional investors invest in the PIPE, agreeing to buy stock at the same time as the SPAC merger. The PIPE investors usually invest on the same terms as the SPAC investors, but without having to pay the same high fees that are usually packaged within a SPAC. And I've gone through those fees in a prior video. So Trump Media and Technology Group and Digital World Acquisition Group, the SPAC, announced a $1 billion PIPE deal about a week ago on December 4th. And because the SPAC, DWAC, is up a lot in anticipation of the merger, the PIPE investors don't get to buy at $10 like the SPAC investors did. They're instead putting in $1 billion to buy 29.8 million shares. But this price is subject to downward adjustment. The actual number of shares that the PIPE investors get will only be fixed after the SPAC merger closes. But at present, this means that the PIPE investors will be paying $33.60 per share. This price is higher than the $10 that SPAC investors paid, but lower than the $56 that it's trading at right now. Okay, so how does that downward adjustment work? Well, according to the documents, once the merger has closed and Trump Media and Technology Group is public, the average closing price of the stock will be calculated over its first 10 days of trading, and that average will be used to compute the final number of shares that the PIPE investors will get for their $1 billion. If the 10-day average closing price is $56 or above, there'll be no adjustment, and the PIPE investors will buy stock at $33.60 per share, getting a return of 67% or more, depending on the price the merged company trades at. If the 10-day average is below $56, the PIPE investors are given more stock for their $1 billion, such that they get to buy stock at a 40% discount to whatever the average calculated price is. But this is floored at $10, meaning that if the stock trades at an average price of $16.67 or less, the PIPE investors will buy at $10 per share. So in such a scenario where the stock trades below $10 per share, they'll be buying at 10 and losing money on the deal. There's another protection in place for the PIPE investors too. They're guaranteed that they'll be able to sell their shares the instant that the merger closes. Now, this is a bit of an unusual provision in a deal like this. Usually the way these things work is that the company agrees to file a registration statement with the SEC and work to get approval after the merger so that the PIPE investors can then legally sell their shares. And this can take some time. In this deal, a condition to closing the PIPE is that the registration statement allowing them to sell must be effective before the merger closes. Now, of course, some of you might have spotted a trick here. An investor in this PIPE deal could just sell shares in DWAC short right now. This would hedge your PIPE shares that you'll get for $33.60 or less on the day of the merger. You get to lock in a guaranteed profit and take almost no risk at all. If the price of DWAC is trading below $56, you get even more shares, so you might make even more than the guaranteed 67% profit. So, of course, there'll be a provision in the deal preventing PIPE shareholders from shorting the stock, right? Well, let's look at the securities purchase agreement. It's available online, and we can see what it says. Well, here on page 20, section 3.1 BB part 3, it says that PIPE investors are specifically allowed to have a short position in the common stock without limitation. So there you go, an arbitrage. If you're an institutional investor and you can get in on this deal, you get free money, basically, a guaranteed return. There are ways that it could go wrong. You might short the stock to hedge the PIPE deal, and then the stock could rally, and if your short borrow was not secure, you could get bought back in at a loss by your broker in a short squeeze before you have a chance to cover using your PIPE shares. But anyhow, people tell you there are no arbitrage opportunities in markets, but this deal is as close to a risk-free return as you'll ever see. If you enjoyed this video, you should watch this one next. See you later. Bye.